But now for some further news on the insights shaping the overall markets. I'm now joined by Ted Thatcher, who is the president of Bright Lake Wealth Management. And Ted, thank you so much for being with us today, first and foremost. But in your view, as we start things off, how serious right now is the risk that higher energy prices could lead to this right now really inflation-driven overall shock to the U.S. economy?
Yeah, Jenny, it's great to be with you. I would say the markets have been on pins and needles, but after all the headlines and how they've shifted this morning, with all the green, I think there's a little bit of headline sort of fatigue in the market right now. The truth is, at this point, I think the street is really just saying, hey, once you have some real data in terms of changes, adjustments with everything going on in Iran and throughout the Middle East, then we will move. Again, the point being, when I see crude WTI at 110, I think that's the street simply saying, hold on, we don't believe that we are out of the woods on this yet.
I think the market definitely agrees with you there. And we know with growth estimates coming down and inflation expectations moving up, what would right now tell you that we are falling into maybe this true stagflationary environment?
Jenny, when we think about stagflation, the hallmark of stagflation is inflation, headed north and the labor market headed south. And that's exactly what we are seeing today. And it really puts the Fed in this terrible bind. The Fed's nightmare is this situation that I'm describing here. And when we think about the cause for the inflation we're seeing, throughout COVID, we saw this demand-driven inflation. That's not what we're seeing today. We're seeing supply side restrictions driving inflation. And so in order for the Fed to actually be able to break that type of inflation, it's going to have to take some extreme measures if this, whole conflict persists.
Okay, that was actually going to be my next question. As we know, growth estimates coming down, inflation expectations continue really to, drive a lot of, I think, then the Fed's next move. I know that some of the labor data we got last week also maybe put a pause on that. But as far as assessing some of the growth from bond data and also just the overall expectations for the Fed, do you think right now the Fed is in a very difficult position just given the conflicting data and obviously the looming threat of just geopolitical tensions?
No, again, absolutely. It puts them in such a bind. We think about the bond market. It's sort of been a little bit of a governor on some of these policy talks. Obviously we saw the 10-year spike up and it's kind of pushed some of these, negotiations, ceasefire discussions. And, that, is exactly what the Fed's thinking about is the cost of all of this. And again, when we pair that inflation with the consequences on the labor side, yes, we saw some labor data, but I think the overall trends, have been really cracks, if I could be really kind about it. And so when you have that rock in that hard place, it does kind of beg this question, how much of an economic downturn are we willing to put the economy through to tamp down the inflation that we will see certainly as this conflict continues to persist?
Okay, to shift gears a bit, you have flagged mega cap tech as a potential opportunity, as I think most market participants are really saying right now for the overall just recovery of this market. But what specific valuation or technical signals would make you more comfortable perhaps buying from here?
Yeah, I'll pick out one name to start with. That's Microsoft. Microsoft is, gotten really beat up, I think, in the news headlines. And if you ask me, Microsoft's going through a moment that Google went through about almost a year ago now. If you rewind the clock to where Alphabet was actually in May and June of last year, we were putting them out on the green mile. They were on the, way out. We were saying ChatGPT was going to take over their search business. And really what's happened since then? They went from trading at a PE of 18, 19 times to now trading at where the S&P is around 28, 29. And I think Microsoft is going through, again, the same type of situation, but with Anthropic. Google was able to use its distribution to its advantage in its AI play, and I believe that Microsoft will in the future as well. So that's the sort of turning bull case for it. But right now, where it's sitting on a technical standpoint is below the 200-week moving average. And I love to quote Charlie Munger. He always said, if you just bought amazing companies on the 200-week moving average, you would outperform the S&P 500. The problem is most people just don't have that kind of discipline.
It's a great point, though, as well. And I will say that Microsoft, a lot of these names, I feel like the next wave of growth is we need this like real proof of concept for like monetizing all of its AI spend. And you mentioned the comparison of Alphabet, but both names have been a bit hit by some of the concerns about how quickly they're able to monetize these products. Does that give you any concern when you look at a lot of these mega cap names that are spending so hugely right now in AI?
Of course, I'm an investor, right? We work with investors every single day. It has to come back to ROI. I do believe that it will come all the way around. The truth is these large mega cap companies, especially in the name of Google, they're funding these things from cash flow. And that really is important to me. If I may also pick out another name, though, Meta does stand out to me when we talk about the ROI discussion here. There is nobody out there today that gets the kind of ROI on their AI spend as Meta does. We could talk about their Andromeda algorithms for targeting. We could talk about their ad platform, adding the Advantage Plus kind of siphon within it that allows advertisers, small businesses and large advertisers to not just use their Andromeda targeting, but allows them to create ads on their platform. And again, I'm just really impressed with how quickly that name Meta has been able to do the quick turnaround when it comes to the ROI side as well.
Yeah, and I mean, I think an important theme you mentioned is the sustainability of that ad pricing. But as far as like its broader hyperscaler spend, I know Meta has been criticized because it doesn't really operate in the cloud the same way like AWS, Microsoft, Google do, because obviously they're able to capitalize on the fact that they're renting out that space. Meta is a bit different. And so as far as ad spend, I completely agree. But then is there any concern with Meta and some of their growth prospects moving forward because of the fact that it is heavily leveraged again to its AI spend?
No, is it a perfect name? And no, it's not. And yes, I think that the natural criticism for all these mega cap names, of course, has been how much they're spending. We could go even further. Facebook was in the headlines, of course, because of some of the regulatory concerns there. I just think that when I look at the overall trend, think about the last couple of years, there's been such a narrative that these large mega cap names are just so overvalued. The average small man investor can't get into the market. And when I see the kind of pullback that we have, to me, that looks like a potential buying opportunity for those that have maybe been on the sidelines, been a little bit concerned about valuations. And so, again, sometimes when you get those muddy waters, you do get a few opportunities.
Yeah, and I think, thank goodness, because a lot of these names, frankly, we needed to see a bit of come down in valuations. I know that was the big concern, but hey, as you did say, we're looking at things a bit more on sale, at least as far as our mega cap tech is concerned. But so appreciate your time today, helping us kick off this trading week. Ted Thatcher, president of Bright Lake Wealth Management.